Everyone. No worries. Hi, everyone. I'm Barrie. I'm a second year MBA and an EIPer for those who don't know me. I am super excited to be kicking off Carbon-Free Chats, a kind of less carbon intensive fireside chat, since as we know, fire is a little carbony than we'd like. And, this is an opportunity Ryan and I are excited to have in order to kind of spotlight all of the amazing people we have in our class who can help us make sense of the fast-moving updates in the sustainability space. So super thrilled to have everyone here. And yes, LED side chats could be our next name. Super excited to have everyone here. Thank you to everyone who submitted questions on this, and we'll definitely get to a few of those. So thanks for helping shape this, and I'll pass it off to Ryan.
Everyone, thanks for joining us. My name is Ryan Bolles. I'm a second year in the business school, also in the EIPer program on the energy track. I think we just recognize that there's a lot of people in our school and in our program and on this campus that have a lot of really interesting backgrounds, experiences, ideas, and thoughts, and we're excited to be able to share them with everyone. And I'll let Nate introduce himself.
Hey guys, thanks so much for having me tonight. For those who don't know me, I'm Nate Jacobson. I'm an MBA too. Prior to coming to the GSB, I worked at Citi in New York, and I worked on Citi's equity capital markets team. And so what that team does is we're basically the team that helps companies go public or otherwise access the equity markets, kind of all the way through the IPO bake-off through the pricing of IPOs. And so the IPO market and now the SPAC market is something that I've tried to follow since leaving Citi and coming to the GSB. So excited to kind of dig in to some of the topical issues tonight. And thank you, Barrie and Ryan, for setting this up. I'm fired up.
Awesome. All right. So let's start at the really high level, because yes, we're all in business school, but I think we take a lot of previous knowledge for granted. What exactly does it mean for a company to go public? Not even just as a SPAC, but just in general, what does that mean?
Yeah. So going public at a high level means to sell shares to the public market and public market investors for the first time, and to list those shares on a stock exchange like the New York Stock Exchange and the NASDAQ. So this is really an inflection point in the company's life cycle where they're going from what could be a very secretive type company that isn't disclosing a lot of information and very protective of IP to a company that now has to abide by public market regulations and disclosure requirements. And so typically, right, companies start as startups. They raise private capital from venture capital funds, growth equity funds, private equity funds. At some point, given the return horizons from private market investors or the need for the companies themselves to kind of cash out on higher valuations, going public and listing kind of provides a venue to liquidate your shares if you hold them in the private entity.
Awesome. All right. And so, there's a lot of ways we've seen that companies can go public, right? We're obviously here to talk about this new mythical SPAC. But, we've more commonly heard of IPOs or Spotify's direct listing. So can you just go through the different ways that a company could go public and also the pros and cons, and just kind of explaining the difference too?
Yeah. So why don't I start with the pros and cons, and then I'll kind of jump into the different kinds. So I think, and this is a bit of the pros and cons of doing from the lens of a traditional IPO, but most of these are applicable to all three. So kind of the main reason companies tend to go public is because they actually have a need to raise capital. And this is a new type of shareholder base to raise that capital from. So typically what you see is IPOs are raising primary capital, which means the proceeds go to the company. It's not an existing shareholder that's selling. and companies typically sell between 10 and 20% of their market cap at IPO through a traditional IPO process. The second big pro, I've already kind of alluded to it, is it provides a liquidity opportunity for existing investors to finally kind of get some cash out of the company. And the third reason, the same for founders or employees. So if you're an employee at an early stage company and you've accrued a lot of stock, this is a good chance to finally cash out. A fourth reason that I think is probably underappreciated, a fourth pro here, is analyst coverage from large institutional investment banks. They all have equity research arms. And typically banks have policies where they initiate research coverage on anything that they underwrite. So this is one of the benefits of having a lot of banks come help execute your IPO is you end up getting a lot of really good equity research professionals putting out thought pieces about where they think that your stock is going to go. And if the analyst really likes your company and is supportive of it, that can help drive share prices higher. A fifth reason is the public markets give you access to a new shareholder base, right? And so similar to how private companies are really thoughtful about which VCs they bring on board, public companies need to be thoughtful about who are their public shareholders. From my experience, there's a set of really high quality blue chip shareholders that actually having them in your shareholder base is a positive signal that can help support the share price. So if you think of your BlackRocks, Fidelities, T. Rowe Prices, Wellingtons, these are the kind of shareholders that if they come up on a Bloomberg screen are just a signal of quality. I think a sixth pro here is it's a marketing opportunity. I think more people will understand and have mind share of what your company is and does if like Jim Cramer is opining on it on CNBC, or if when you ring the bell, you show up on TV. And one of the things we used to put in pitch books for IPOs is what are the creative ways we could do some sort of sample or service offering outside of the stock exchange when you're ringing the bell. Things like that. In terms of cons of going public, the first is the pressure of the public markets. So, I think public market investors in the stock market is really unforgiving. Generally, bad news will move stocks lower. And, when Elon Musk was tweeting about taking Tesla private a couple of years ago, this was kind of one of the things that he really focused on is, being a public company exposes you to the quarterly pressures of having to set and then meet expectations. A second con of going public is kind of the flip side of the shareholder base side is you have a lot less control over who are now your shareholders. So you might get hedge funds in there. You might get activist type investors that want to exert some control and influence over how the company is managed. And this can be another negative in some ways. And then, I think another con is public market readiness is generally kind of burdensome. And so private companies, right, they're not necessarily held to a handful of public disclosures and reporting requirements, but building out the infrastructure to do that consistently and in a timely manner is expensive, right? And so is hiring lawyers and accountants and everyone to review and file those documents. So I've been going on a while. So those are kind of the main pros and cons of going public. So now I'll dive into a really brief overview of kind of the three ways of doing this. So a traditional IPO, otherwise called a book build, is when a company basically, hires a set of banks. They prepare an S1 disclosure document. They launch their deal and go out onto the road or do an IPO roadshow for about 2 weeks. Those used to be in person. It'll be interesting to see after COVID, whether they ever go back to being in person, but typically the management team, which would be the CFO, the CEO, some poor junior banker who has to bring everyone coffee, kind of go out on the road and go and meet with investors in their offices. and basically pitch the IPO. And what happens then over the course of 2 weeks is the investors build their model. They come to a view on whether or not they want to own the IPO. They make their own projections. They go to their own internal investment committees. And then ultimately they call up the book runner that's leading the deal and say, I'd like X number of shares, and I'm only willing to pay, or I'm giving a limit price of Y dollars. So basically saying, just like an auction, if you price above what I'm willing to pay, like I don't want anything. This introduces a ton of auction theory and coordination problems and incentives to like play games with bids and things like that. And so that's been a one, kind of that structure has been a catalyst for people saying, there's structural problems with this process where companies are getting underpriced. Recent examples of regular book build IPOs this year include Airbnb, DoorDash, and Affirm. So those are kind of the big flashy logos from the IPO market so far this year. Direct listings are relatively new in popularity. Direct listings are essentially where the company just lists, right? And so recently there have been some adjustments where they can raise primary capital, but in their initiation, or like at the start, really, this was truly all of a sudden you flip the switch on, the company's shares now trade, and secondary sellers who want to sell can. The problem here is that there is no price discovery. And so you open yourself up to really volatile early trading. There's also no intentional allocation or building of a new shareholder base. So it's kind of like your VC starts selling and the people who buy it are whoever they will be, right? And so if you're a really high quality company that investors would have participated in a regular IPO anyway, this problem solves itself, right? Because you get the blue chip investors to come into your stock, but otherwise it could potentially be a problem. And that's why you've really only seen direct listings again in these unicorn type companies. So recent examples are Palantir, Slack, Asana, and Spotify. Those are probably the ones you've heard of in the news. And now to SPACs, what's brought us all here tonight. So essentially, a SPAC is a blank shell company. SPAC stands for Special Purpose Acquisition Corporation. And at the highest level, a SPAC is basically a sponsor group, which tends to be titans of industry. Now they're more like celebrities, politicians, sports figures, but people who essentially raise hundreds of millions of dollars on a promise to go buy something. So it's kind of like a public market search fund. And typically the SPAC has, or they at least disclose, an industry focus in a set of criteria that they're specifically looking for the SPAC. And then they have 18 to 24 months to go out and source a SPAC, source a company to buy. So what has happened is now a company that has no operations has gone public. It's raised the IPO proceeds, and it's put all of that money into a trust that gains interest. And then the money just sits there. And the money is going to be used within 18 to 24 months to go buy something as the M&A consideration. And so basically a SPAC is like a backdoor way of going public. You avoid on the front end of going on a real lengthy roadshow, at least from the perspective of the company that's being acquired. But on the back end, once the M&A is announced, there's another transaction called the de-SPAC, which is kind of the merger itself. So you have kind of the IPO up front, and on the back end, you have a merger. And that's something that's subject to kind of the proxy process and a shareholder approval. And so where some of these SPACs get tripped up is if it's a bad deal, right? The SPAC might not be able to close it. right? And so we'll get into some of the, some of this in a bit, but what could happen is if it's a bad deal, the investors could, instead of choosing to vote for the deal, they could redeem the shares that they had bought earlier. It's called redemption rights. And essentially the money comes out of the trust. So if it's a bad deal, investors will take their interest and their principal from what they paid in the IPO that's just been sitting in a bank account, basically, and they'll just take it back. And so what'll end up happening is the SPAC will have less money to actually buy the company for. So, these are highly technical and fairly complicated transaction types. But I think at the highest level, it's a shell company goes public and decides to buy something and then reverse merges. And so the public entity that trades after the merger is now the previously private company. Ryan, Barrie, did that make any sense?
It made sense to me. I mean, it seems like a crazy investment vehicle. Ryan.
Yeah, no, I liked it a lot. Thank you. Very coherent way of describing. And to your point, it is very technical. So there's obviously a lot of stuff to discuss there. We've seen a huge rise in SPACs in the news, on headlines, and specifically, as part of the energy club, we've seen a lot of it in the energy space. Do you have any thoughts about, why there's been this recent rise in popularity for SPACs?
I do. I think actually, I know you said no slides, but I'm going to share one slide because I think it's helpful for
Nice.
people to get. Are you able to? I always click that wrong button. Can you guys see this?
Yes, I like your rule breaking mentality, Nate.
You like that? So essentially what this is kind of a state of the IPO/SPAC market as of Friday. So what I think is kind of interesting here is in the top left graph, monthly deal volumes. And also I'm taking feedback on the emojis, guys. So anything is helpful here. So what's really interesting is volumes in the IPO market and in the SPAC market are really elevated right now. And so already in January, there have been $25 billion of SPAC, like the front end shell company IPO proceeds raised. And already in the first week of February, last week, $9 billion raised just in SPACs, which is this dark purple graph under 221. And over the past 12 months, right, this is like the magnitude of this boom, is $107 million or billion dollars, excuse me, of SPAC proceeds have been raised. And typically, and that's relative to tech IPOs, which is only 42 million, right? So it's almost an order of magnitude more in the SPAC market. So that's just a level set. And I think under the kind of the middle bucket under on the right-hand side, key SPAC mergers announced this week, like there's some like really flashy names in here, including like Autonomo, Wheels Up, REE is one relevant to this group because that's one of the electric, kind of the bed of the car, right? Battery and type companies. And 23andMe is another one that just got announced, which is pretty interesting. So I will stop sharing my screen, but I just wanted to give kind of a sense of like the magnitudes we're talking here, that the SPAC market right now is larger, more than 50% of the total IPO market, which back when I was at Citi 2 years ago was like SPACs were at best a quarter of the volumes and boring, and no one cared about them. And all of my peers really did not want to work on them. So to answer your question, why is this the case? The first reason is market volatility. So one of the key pros of going public through a SPAC, if you're the company going public, is that, I mentioned earlier the IPO process, there's this coordination problem in terms of convincing a handful of investors on the roadshow of what is the appropriate valuation for your company. when the markets are volatile and all the investors in the public markets are seeing, have to protect kind of their returns, it kind of sets off a risk averse mindset. So they become less willing to engage with the IPO market because these tend to be pretty risky investments. And so because the market volatility is so high, and so the VIX is kind of the benchmark that people look at, it's been elevated over 20 for over a year. And so when I used to make these dumb little graphs that showed the VIX and showed where like we would recommend not launching, 20 was the baseline, right? VIX over 20, you would say probably don't launch a regular IPO because you're taking a lot of market risk. That was also when I was covering industrials and Trump was tweeting about trade wars. So that was part of it. So because we have this sustained elevated market volatility, that's one reason why companies are electing to go public through a SPAC, is because you only negotiate valuation with one counterparty, which is the SPAC sponsor. And so that really de-risks and takes out the coordination problem of going public. The second reason SPACs are popular is kind of because of the low interest rate environment. And so, treasuries are not at all-time lows, but they're pretty low. And essentially the opportunity cost, if you think of a SPAC investor, which tend to be hedge funds or more arbitrage oriented type investors, they can afford to put money in this trust for 2 years because it's earning interest, and it's all relative to like zero interest type government type securities, and so it's willing to take just put your money in cash in this trust and hope that the M&A is huge, and then you get to play the M&A arbitrage and kind of get the pop from there. The third reason that I think SPACs are gaining popularity is because there are a lot of loud voices that are arguing pretty effectively that the IPO process is broken. And so here is I'm going to put in the chat a blog post by Bill Gurley, who does, I think, the best takedown I've seen of the IPO process and why SPACs are actually just fundamentally a better way to go public. I think that's something that's debated, but if you believe it, then that's another reason why companies are choosing to go this route. The fourth big reason is I think that private companies are staying private longer. We have more unicorns than ever. And, these companies are, for whatever reason, unwilling to go public through the traditional process. And you probably have investor pressure on the private side to see exits from some of these blowout deals. And so you might get some investor influence saying, hey, like, this is a better way for us to achieve a liquidity event. And the fifth reason I would say, I love lists. So just so everyone knows, I have 7 reasons. I'm on 5. So the fifth reason is that unlike direct listings, or at least the initial version of direct listings, you can get primary proceeds from the SPAC because you get all of the IPO proceeds that the SPAC raised, and typically an additional PIPE investment, which are pretty common to go alongside of the merger. And so what you can do is actually get more cash from this transaction at an equivalent valuation than you could through going public. And I'll give a really quick example of that. So, Proterra is the electric bus company that just announced it was going to be acquired by a SPAC at a valuation of $1.6 billion. So if you're Proterra and you're set on achieving a market cap of 1.6 billion, but you want to go through a regular IPO process, typically you sell about 10% of the company in the IPO. Part of it is because the IPO is supposed to be kind of the most expensive stock you sell in the sense it'll be the lowest price if everything goes right. So you don't want to sell all that much at the start. And so that would imply Proterra, if through a regular IPO, we'd probably only recommend they raise like $200 million, right? In the SPAC, they're getting like in excess of $600 million. And And so what they're able to do now is, that probably takes them a lot further in kind of reaching their milestones than just $120 million would. And therefore, they don't have to actually come back to the equity markets as soon as they might have otherwise for a second deal. So I think that's probably one of the, top reasons that at least companies are seeing this as really attractive. The sixth reason is SPACs are much faster, the process from the perspective of the company being acquired. So if you're going public the regular way, it takes 6 to 7 months to get everything prepared. The SPAC process takes more like 4 to 5 months or sooner. So companies are able to get out faster onto the public markets. And then the last reason, which is my favorite, is because of FOMO, which I think resonates really well with the GSB. And so it used to be, SPACs were kind of this bespoke transaction for kind of retired CEOs to keep themselves busy. Now we have like celebrities, like Richard Branson raised a SPAC, Reid Hoffman raised a SPAC, Bill Ackman raised a SPAC. So these are these famous people from the world of business. Politicians are raising SPACs. So Gary Cohn, which is President Trump's former economic advisor, raised this $830 million SPAC. Paul Ryan, the former Speaker of the House, has a SPAC. John Delaney has a SPAC. He ran for president, I think, the last time. And then Wilbur Ross and Larry Kudlow have a SPAC, right? So these are like, leave the Trump administration and raise a SPAC type people. And then athletes are raising SPACs. So Billy Beane, who is the Moneyball guy, raised a SPAC, and they tried to buy the Boston Red Sox, I think, but they didn't. Shaq has a SPAC. And A-Rod yesterday, Professor A-Rod announced he's jumping in the SPAC game. So it's almost like this, it's the thing to do if you can, and it seems like people can. So yeah, those are my top 7 reasons why the SPAC market is booming.
Nice. I like them. One couple clarifying things in there. You mentioned primary capital and PIPE, and I think just so to clarify, correct me if I'm wrong, primary capital is money that is raised that can go on the company's balance sheet.
Yeah, so this is kind of like, this is new money, right? It's like, no, they're not getting like proceeds from people selling. This is like new infusion of capital.
And there's been a change recently with direct listings as well, right? There used to be an issue where direct listing capital proceeds from direct listings could not go on the balance sheet, but that subsequently changed. Is that correct?
I believe so. I'm not quite as well versed on the nuances of direct listings, but I think that's right.
Okay, we'll put an asterisk on that one. And then you mentioned PIPE, so it's private investment in public equity.
Yeah.
So it's
on
that definition.
It's a private placement. So it's kind of like concurrently with this transaction, you raise kind of a sidecar through like another private round.
So an example there might be a private equity fund that probably pays a discount to buy equity in whatever, either in the SPAC or in the target company.
It'll be in the target company.
Okay.
Yeah.
Awesome. Thanks, man. Those are great points. As we mentioned, this is probably one we've seen a lot on the headlines, and to your example, Proterra, I've seen a lot of it in the EV space. And we're just wondering if the research you've done or anything you found kind of gives you some signals as to why there's been a meteoric rise in EV SPACs.
Yep. So I have a short answer and a long answer. I think I can. Do I still have my slide available? No, I closed my slide. So the short answer to why EVs in particular are taking off in the SPAC market is Tesla. And basically, my view is there are kind of like 2 sides to this. There's both the investors want to own the next Tesla and believe that Tesla is at the forefront of just this huge transformational shift, and so they just want exposure to like the next guy, the next company that's super early. in a hope and a prayer, it'll be the next Tesla and catch lightning in a bottle twice. The second reason, kind of the flip side, is, people might want to diversify away from Tesla, right? So before kind of this wave of EV SPACs and IPOs, the only way, if you're a public market investor, that you could get exposure to this theme and this trend was through Tesla. And Tesla, like, even though it's made people like tons of money, now Elon Musk is the richest man on the planet. Not too long ago, like, people were really frustrated by this stock because it would just go, it was super volatile. It was the most shorted stock in the stock market. And, in Elon's erratic kind of tweets and the things that would move the stock really frustrated people. And so, like, hey, wouldn't it be great if there was a way I could still like own EV exposure, because EVs are going to be everywhere, but not have to deal with Elon, right? So it's kind of two sides to the same coin. One, it's like, can we catch the same Tesla, situation? And the other is, can we avoid doing it with Tesla? The long answer is, the capital needs of these businesses in terms of R&D are really heavy, right? And so this isn't unique to Cleantech, right? This is also why we've seen some of the LiDAR companies for autonomous vehicles go public through SPACs. But essentially, I think a nuance I forgot to mention at the start is, when you go public through a regular IPO, you're only allowed in your S1 to disclose up to 2 year, or a minimum of 2 years of historical financials. It is then up to, and you're not allowed to give projections. So it's then up to all of the investors and research analysts to go out and make their own projections and do that work. And so what happens is you get lower valuations, and you have this coordination problem where not everyone probably sees what the company sees in terms of opportunity. So if you go and look up any of these SPAC investor presentations for the ones that have been announced, they'll show you that I was looking at the REE one yesterday. So that's the electric, EV SPAC that was announced like yesterday or on Friday. And they literally have a graph that doesn't even have 2022 on it to show their revenue ramp, which is next year. They don't even have that on the graph. It starts in 2023, but it's going to be a public company, right? And so the idea is that they can actually market and negotiate valuation with the sponsor through projections that are really amazing, right? And even the LiDAR SPACs, they depend, their revenue projections depend on autonomous vehicles becoming a thing, right? And so it's kind of risky in that regard. And so that's another reason why Cleantech really fits that bill well. And then, I think just the broad tailwinds around electrification that we see in the news that are topical, whether it's like the Biden-Harris plan, GM's initiatives around electric, Walmart, Amazon, UPS trying to electrify their fleets. It feels like we are at the tipping point for when electrification broadly will finally become a real thing. And so, like, now is the time, if that makes sense.
How exciting. Super exciting. We're at the tipping point. You said that last night and I was like, that feels so good. And we're all like studying this stuff and care a lot. And it just feels really exciting to see electrification take off. And I wanted to jump in with it. We got this question both in the chat and earlier on the survey, but there's kind of this question on, is this a bubble? Is there a concern about the horizon on SPACs? We've raised all this money. Maybe you can't find companies. What does this really look like in the long run?
Yeah.
Or in like short run, 2 to 3 years?
So it's a really good question. And I think, the answer kind of is predicated around like how many companies really are there that are winners enough to be public companies, right? And like, how many different versions of, battery technologies or charging technologies or, models of EVs does the world need? And presumably like some are going to win and some won't, right? And so, um, so basically all these SPAC proceeds are M&A dry powder that have a deadline on them. And to the extent that SPACs stop finding worthwhile companies to invest in, and then therefore they will stop raising SPACs. It's like everyone who could be a SPAC is a SPAC, and we're done, right? There's probably a limit to the universe. The other thing is like what happens when these companies start reporting earnings and they just are like, yeah, like we don't have revenue still, like, yeah, we're still, building a product. Eventually, the public markets are going to be like, well, this is taking too long, right? And it becomes a real problem when you start to miss your own projections and expectations that you're setting, right? Like everyone who's been ever managed an intern knows how frustrating it is for the intern to say like, I'll send you the thing I'm working on by 4, and then they don't, right? And so that's kind of like the analogy here is you start to lose faith in like the quality of these things. I think a good analogy of this, and obviously Tesla is not a SPAC, but through kind of 2018, end of 2017, end of 2018, like Tesla got crushed because they were consistently underperforming their Model 3 ramp expectations for just getting the Model 3s up and running, to the point where there would be these news articles where, Tesla is like building Model 3s under tents outside of the factory just to like bare minimum to count them as Model 3s to show that they're counting that, to show that they have as many Model 3s as they said they were going to have. And so like this is going to potentially be a problem for all of the SPAC companies that at some point are going to have to show material progress. So yeah, that's a long way of saying like, are there enough quality companies out there to satisfy the dry powder that's been raised? Right now, it seems like people assume so because they're still willing to give this money to SPACs. But I mean, it's nuts. It's so much.
Yeah, those are great points. I think that does add some framework that we can use kind of thinking forward. And give you maybe help solve the question like, does this make sense? One other question I received beforehand that we were hoping you could cover is kind of just around company characteristics. And what are some of the things that would suggest a company to be a good SPAC candidate for the M&A there? I mean, I'd love to hear your thoughts around that.
Yeah, so there are two parts to this question. So I think the first part is, does the company as an M&A candidate line up to like what the SPAC is specifically looking for? And so when the SPAC files their IPO documents, they typically say like, here's the criteria that we're specifically looking for the IPO. And so here is an example in the chat of that. So this is some random blog I found about the Bill Ackman SPAC, which was the biggest SPAC of all time, $4 billion, which was rumored to have tried to buy Airbnb, for example. So part one to your question is, what makes a good SPAC target? And the answer is, it depends on what the SPAC wants. The broader answer is, from the company's perspective, like if you're in a company, how will you know if you should do a SPAC versus other things? A couple of things jump out to me. So one is like, you want to be a public company, and right, and you're up for the scrutiny that brings and the reporting requirements that brings, and potentially the shareholder activism it brings, and everything like that. Because going public, right? I mean, we're talking about these SPACs tonight. It's a splashy marketing thing too, right? So it could help with business development. It could give a signal of professionalism isn't the right word, but like a signal of maturity as a business to actually help be accretive to the business development effort. And you don't, I think another part of this is you don't want to be bought, right? I think there are kind of, if you're thinking of venture-backed companies and the three major ways to exit, there's going public, the two major ways to exit till now, there's going public and there's being bought. And so this kind of splits the difference. It's kind of like being bought, but you're now public. You're not really, you're not a subsidiary of a bigger company. The other thing I'd say is if you think you can raise enough money in the SPAC merger that you can kind of insulate yourself from needing to go back and raise more public capital over time, to kind of weather the storm of like the growing pains of ramping up the business, especially if you're kind of still in the R&D phase, right? So it's like, do you have enough money that it doesn't matter if you miss your projections and your targets, because your stock can get hit, but you don't need to raise more or sell immediately, because you've raised enough in the deal. And then I think the third and probably the biggest reason is if you're one of these companies that really needs to market those future projections and this state of the world where everything goes right, in order to achieve the valuation, it's almost like achieving a private market type valuation in the public markets. If that's really important to you, then SPACs make sense. And then a final reason, I don't know exactly how big of a reason this is, but relative to just raising another VC round, for example, is you might want to sell common shares instead of preferred shares. You might rather do that. And this is a way to do that as well.
Great points, man. Thanks.
Yeah, I think that's about time. I did see two kind of like quick technical question, or not technical, but just I think you could answer fairly quickly. One is if a company goes public through a SPAC, whose stock do you buy as an investor? Is it the SPAC's stock or now Proterra, for instance? Or how is it listed?
Yeah, so there's a period between when the M&A is announced and the deal and the M&A closes, where if you were to buy the SPAC, you would be buying the SPAC, right? There's a lot of kind of strategy, and like this is called like shareholder rollover, where you go from kind of hedge fundy arbitrage investors who buy the SPAC at the start, who then say, okay, like I'm a SPAC investor, I don't want to own Proterra, I wanted to own the SPAC, who then now sell to someone who wants to own Proterra. So that can happen in between the merger announcement and the merger closing, in which case you would own the SPAC. Once the merger closes, the ticker changes and you don't have to do anything. It's now Proterra, right? So that's like mechanically how it works. Yeah.
Super cool. Yeah, I think that makes a lot more sense. It'd be a very weird branding thing to want to buy Proterra, but then have to buy, blah, blah, blah SPAC.
Yeah.
And the other question, and if you aren't sure if this is, going to take too long, we can table it, but there's some question on the governance, like who is in charge of the company now? Is it the investors or partners on the SPAC, or does the leadership stay at Proterra and now maybe a few of those SPAC partners become board members, or what does that look like?
Yeah, so it's closer to the latter. So typically the company's management team stays and continues to run the company, because they're by the way in the investor presentations, it's usually like one of the top investment highlights for why they're doing it is because the team is awesome, right? It's similar to like venture investing in that way. The SPAC sponsors then they end up owning like a significant portion of the merged company, somewhere like 20%. So they're large shareholders. And then my understanding is they typically take board seats. And so they become like strategic advisors. They leverage their star power for business development. And they're huge shareholders. And I'm sure the governance stuff is much more complicated, and that kind of extends past my expertise. But
We'll have to get Larker on it.
Yeah, exactly.
All right. I think those were the main questions from the chat and many we got in. Nate, thank you so much. And thank you to everyone who came on a Monday night. If you could just join me for like a reaction applause or whatever feels right to you on Zoom. I learned a ton. I feel like, yeah, I can see you as a guest speaker in Finance 207 in like a few years. So, all right. Thank you all. Have a good night. Happy